Okay, so a very good afternoon. I'm just going to give the other participants a couple of seconds to enter the room and we'll get this underway. I do apologize for the somewhat delayed start. We had a few technical difficulties, so just bear with me. Okay, so let's get this underway. Thank you very much for attending and thank you for your time to join this webinar on key support and resistance levels, a different way to navigate market structure. So, my name's Aaron Hill and I am the Chief Market Analyst here at FP Markets. Now, I've been involved in the financial markets since about 2010, so it's 15 years. That's just flown by. So, there's not much I haven't seen. Look, in terms of qualifications, if you're interested in taking technical analysis to another level, you can consider you may want to consider the CMT, the Chartered Market Technicians course. I did the levels 1 to 3, and it really opened my eyes to how in-depth technical analysis can really go. Also, recently received the CFTE qualification in 2020 on the back of the level 2. Okay, so I assume the sound and the visuals are good to go. If there's any issues, do let me know, and I'll try and get the support team to help you out. Now, this afternoon's presentation is all about, as you can see here, support and resistance, which is the backbone to many active trading strategies today. So for me, at least, support and resistance is not how can I put this? It's not a fixed strategy um, where you have one way of determining support and resistance. There are several forms of support and resistance, which you will see a number of those in this presentation. I've personally found some approaches perform better than others, though often a filter is needed to avoid the whipsaws that can and often do occur around these levels. Ultimately, this webinar will be geared or is geared towards newer traders who are just getting their feet wet. But I sincerely welcome all traders of all experience levels. Now, a recording of this presentation will be available, which can be found on the FP Markets' website under Resources, the Resources tab, or you alternatively just check out our YouTube channel and you'll have access to all of the previous webinars. Any questions I miss during the webinar, please forward those to marketanalyst@fpmarkets.com. We will throw that in the chat box shortly. Please also feel free to email or request any topics for future webinars that you may think benefit other traders. Now, as usual, we have to run through the disclaimer. I'm not going to read all of this out, but suffice it to say, this presentation it should not be considered investment advice. It is simply a educational material only. So, for the purpose of this webinar, we are going to be introducing support and resistance levels. So I'll start off with textbook, with what I refer to as textbook levels, and then we'll distinguish between conventional and unconventional levels. We'll then move on to support and resistance within different market phases. Essentially, that means the trend. And then we'll look at some application techniques and ways of confirming these levels that I personally use. We also have a Q&A session at the end if there's any questions I missed during the presentation. But feel free to ask any questions during the presentation if it relates to the chart in question. Now, this presentation will be more of a shall we say, interactional presentation. So I won't be using slides as much. I'll be going over to the chart, as you can see here. So, to help introduce support and resistance levels, here is the monthly time frame, the daily time frame, the H1, and the M5, the 5-minute charts of the euro dollar. So the euro dollar is one of the most widely traded currency pairs in the FX space. It's two of the most liquid currencies in the world. Ultimately, support and resistance exist as a product of supply and demand. If there are more buyers than sellers, price should rise, right? So if there are more sellers than buyers, price tends to drop. You can think of this as another way. If there's less off, just another way of looking at it, but if there's less offers than bids in the market, when price hits support, price should rise to the next ceiling of offers. And if there's less bids in the market when we hit resistance, for example, than offers, price will fall, reaching the next pocket of bids. So these levels that I have highlighted on the charts right now are what I consider to be textbook conventional support and resistance. So it's very rare to have, I will take this example here. So it's very, very rare to have a support and resistance level that holds pip perfect. So you can see we have a nice test here, we have a nice test here, and then we have a near perfect test of this support here. But these have, for me at least, proven the most reliable in terms of textbook support and resistance levels. I know you should look at these levels as areas, and it's that is the correct way to do it. But I found if once you train your eye to look for these clear cut, I mean those clear cut that really jump out from from the charts at you, these tend to be the most reliable I've found. I do have some statistics to show during to speak about during this presentation, so I will touch on that. But these in terms of textbook support and resistances, these tend to be the most high probability that I have found, but they do take some time to found that while they're incredibly reliable, they can take some time to recognize. A support level going on my definition is simply let me just find a basic, it's simply a price level which has shown, so this is the very, very basics here, guys. A support level is where it has shown a buying interest. So we've got buying interest here, buying interest there, buying interest here. We have a slight slip to the downside here, but we have some buying interest there. I always tend to think of supports as floors in the market that have withstood downside attempts multiple times. To me, two or more tests, and I think that goes for most textbooks as well, two or more tests of the same level is considered support. So this will be your first test here, your second test here. So this is potentially tradable. Now, depending on who you're talking to, this may not be a viable approach for some traders. But for me, textbook wise, this is what I'd be looking at. But look, there is no right or wrong here. Just different traders have different perspectives. Major support levels are often those that have welcomed numerous tests, and the minor support. So when I say minor supports, this would be considered a minor support. Sorry, the M5 one here would be considered a minor support. It's had a couple of tests as resistance, and we've flipped to the upside, and then we've retested that area as support. So it's a minor support area. But when you get into the bigger time frames, so the monthly time frames, we have a test of resistance, a test of support, 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 another test of resistance, another test of resistance. So what do you think will happen once we reach this area? At the very least, I believe price will take a breather if we reach this high. At the very least, price will take a breather. Now, once you get more advanced with price action, you'll note that we have a potential AB equals CD approach towards this area, further complementing this resistance here. So this would be a perfect example to show how you can use support and resistance as areas. So you would initially take this area here. It is subjective, and it takes a little bit of time to get used to it. I would also take these areas down there to incorporate those lows. So that high, those lows, we've already incorporated that low there, and I would continue pushing across. So this point here, we did see a slight overshoot to the upside here, but then we saw a nice test of this area here. And if you look, we are now testing this area of resistance as we speak. But again, guys, this is a longer term, so you can start So with support and resistance, you can look from the top down. So you can start the monthly, you can then work to the daily, H1, and then the M5 for your entry. It depends on what kind of trader you are. So resistance, so we have support, which is essentially where buyers have shown interest at least twice. Then we have resistance levels where sellers have shown interest at least twice. So we have a nice example on the H1 time frame here. We have a test of resistance at this point here, another pit perfect test of resistance at this point, and then we have a near test of the space at this point here. So would I consider trading this resistance to the downside? Probably not, because look, like everything, you can I would never recommend someone trading support and resistance, solely support and resistance, without incorporating at least trend bias. So here we know that the trend is to the upside. We know we have a series of higher highs, higher lows, higher highs, etc., etc., etc. So the trend is to the upside for the euro right now. And shorting this would not be an ideal play. Look, you may still have a bout of profit taking come in at this level, which is fine. But ideally, what I'd be looking for is a breakout to the upside. So I'd be looking for something like this to occur. This is the very basics guide. So I'd be looking for a breakout to the upside and then to trade long on the back of that, because we've now broken a clear level of resistance and trend is to the upside. So we have two factors supporting a trade. I'm pretty sure you've gathered this already, given what I've already shown, but look, support and resistance can be found on any time frame. So it can be found from the M5, the 1 minute time frame for any scalpers watching, the swing term trading time frames, so the daily time frames and the H4 time frames. We have the H1 here, so it can be found across, it's like in technical indicators, right? They can be placed on any time frame. For those newer traders here, so if I was a complete beginner, how would I begin looking for support and resistance? Well, I can remember when I first started trying to identify support and resistance, I started looking, I was advised to start looking at those clear swing highs. So instead of zooming in like this, zoom out a bit and look for those clear swing highs and lows. So a swing high, swing low. Don't worry about the terminology. So this would be a higher, 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 low, higher, 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 low, but just think of them as swing highs. So look for those swing highs and then look to marry them up with near term, relatively near price action. So we have a swing high here, a swing level there. So you could potentially mark this, you could mark this area, that area there, and that area there as resistance. So we have a break to the upside, a fake out to the upside, a fake out to the downside, then a move higher. That becomes quite advanced price action to recognize, but it's certainly something you will want to look into once you understand more about support and resistance. So I did mention that I wanted to talk about the statistics. So I rarely trade support and resistance based on what I have on the monthly time frame there as areas, but really you should. I've just found that they don't work for me. I found them too stressful for me to generate anything worth my time. So I tend to look for those M5. So these pit perfect support and resistances, which are very difficult to find, but very difficult. They're hard to recognize when you're first starting out. But these are the type of levels I'm looking for. Clear resistance. Then I'm looking for a break of that level to the upside, of course, if it's a resistance. But if it's a support, a break to the downside. On average, 55% of these, so 55% of these resistance levels hold on a retest. So, but the break has to be clean. When I say clean, we have to see a clear break to the upside. So one candle. We don't want to see any slow moving price action and a quick retest here. We want to see a nice move to the upside and a clear test of this level to the to rebound to the upside. Now, if you're looking at price action on a more advanced scale, you will have noted that we do also have, I think it was a flag at this point here, or was it a pennant? See, it's a pennant. So we also have a pennant formation forming here. So what you could have done in this scenario, not only have you got a pit perfect resistance to be breached, which has been breached at this point here, we can then look at this pattern forming. We can look at the pattern on the approach to that retest. And that breakout to the upside there could have been your trigger because then you have a pattern in play as well. So additional confirmation. Do I use technical indicators? Now, I used to use technical indicators. I used to use the RSI, and I still do sometimes. Very rare do I glance at the RSI now because you can, with the years of experience I have looking at price action, I've found that I can normally tell when the momentum is slowing on a chart, as you can see here. So let me just demonstrate this. Let me just pull the RSI up here just to show you what I mean. It's pretty simple stuff. So at this point here, you know momentum is to the downside, right? It's pretty simple. You really don't need to look at an indicator for that. You know momentum to the upside is taking a breather, and we know we have pattern structure to base our entry and our risk. So you can place your stop below here and your entry based on that, on the breakout to the upside. I'm not trying to confuse any new traders watching, but this is where you can advance your trading beyond. So you can have, as I said, support and resistance is usually the backbone to any technical trading strategy, and that is what it is. It's the backbone to your trading strategy. You can then further refine. You can then further add things to make it to your add things to your that suits your personal preferences and your trading style. So as I said, 55% of these hold these trades here. So 55% of these trades hold for at least a 1 hour position. So what I mean by a 1 hour position is, so if I'm risking £100 or I'm risking 10 pips here, it tends to rally at least 10 pips, enough to reduce my risk to break even. That was on the M15 and that was on the M5 charts. And this was based over a 2 year testing period. Between 2021 and 2023, I tested this. So this is certainly something to be aware of. 55% hold for at least a 1 hour move. Now, if you're a scalper, that could work out quite favorably. But as I said, these do take quite a while to recognize, and they are quite time consuming to search through those charts and look for that. So if there are any questions regarding the what I refer to as conventional support and resistance, please do let me know. The next chart is where it becomes a little more interesting, in my opinion. Now, for anyone that's followed me for a while or listened to any of my previous webinars, you will have heard me talk about Quasimodo resistance, Quasimodo support and resistance levels. Now, I wasn't a big fan of these when I first heard of it, and it did take a little while for me to get used to, but now they form part of my overall trading strategy. For anyone that's listened to my previous webinars, my recent webinars, you will know that I now combine macro and technical analysis. And these IQMs here, what I'm going to show you right now is what I use as an entry trigger. This and another technique, which I will show you on the dollar yen chart, as you can see above. So here we have a Quasimodo support. This is a very basic Quasimodo support. So we have a low. So imagine prices trending to the downside at this point here. Then we have a low here. We have a lower high at this point. So a swing low, swing high, and then another swing low here. This is at this point here, at this swing low here, we won't know any different. We'll just think this is a continuation of the trend to the downside. But we then get a higher, a swing high. And after it breaks that higher low at that point here, we could be in the running for a potential trend change or a potential uh, medium-term trend change to the upside, or a pullback within the longer-term trend. So we have the swing high at this point here. And then at this point here, we can then project this line here from this shoulder at this point here, this left shoulder. Now, do not confuse this with the uh, the inverted head and shoulders. Do not confuse it with that. I do have a webinar on touches on the difference between those two patterns, so do check that out if you're interested. But then we can project from this left shoulder across for price to potentially reverse back to this area and rally higher. Now, the Quasimodo resistance is exactly the same, but it's to the upside. So we have a trend to the upside, or a move, or an up move to the upside. We have a swing high, swing low, swing high. Again, at this point, we don't know any different. We think the trend is still in play. But at this point here, we have a swing low, or a lower low, if you will, because we've broken this higher low. At this point here, we can then extend this line from the left shoulder across price action to give us a nice resistance level, which tends to react. Now, I did used to trade these Quasimodo support and resistance as this, and I didn't really find much success with this. It was only when I flipped things around and, like a support and resistance, when a support is breached, you tend to trade the retest of that level. And when a resistance is breached, you then look to trade the retest of that level. It's exactly the same here, guys. So if we get to this point here, and then price continues to the upside and breaks that high, this is when I look for this level. These are so high probability, especially following a macro event, especially following something like a deviation in the data. So employment, inflation, GDP. If we see a upside move, so just to be clear, with the macro trading, I am predominantly a scalper. So I look for those clear macro biases. So when there's a deviation between the outcome of the data, between the outcome of the data and the estimate, the median estimate, or the high and low range of the estimate, I will then look to trade based on that. And imagine if price cleanly breaks that level. Remember on that example I showed here, we want to see a clean break of the level. Well, the same goes for this. We want to see a clean break to the upside and a break of this level. Now, this level here doesn't have to be a clean break, but this level does. Just from my testing, guys, again, other traders may look at this very differently, but then I will be looking for a retest of this IQM and then a move to the upside. These have proven to be incredibly high probability for me if you have the patience to wait for them to set up, and they do set up. As I said, these are the key levels that I really look for following a macro announcement, economic data. So I'm predominantly now a news trader. So I wait for the news to come out. I do all my homework before. I understand the narrative of the market. I understand what the Fed is doing, for example, of the US dollar. I understand what a weak employment report would mean, a lower dollar at this point. I understand what a stronger employment report would mean. I understand what inflation means for the selected currencies that I trade. So I would be looking to trade on the back of that. And you'll be surprised by incorporating economic data into your technical analysis, what kind of edge it gives you. You'll be very surprised if you look into that. So this is the ideal setup, as you can see here. So let's move this circle. So there we have it. So we have an IQM setting, a QM resistance setting up, high, low, higher, high, lower, low, and a break of that level, a clean break to the upside, and then a test to the upside. I don't know why these work. I can't understand. I can't really explain the dynamics behind it, but I've seen it time and time again where they do work. In fact, I do have some statistics on through my testing and through my trading. So 68% of the time, these levels hold by at least 1 hour. So 1 times my risk. But that was taken on the daily chart. I haven't tested the lower time frames, but I do trade those on the lower time frames following macro events. I don't have the statistics to hand at the moment, but I don't believe it's 68%. I think it's more in the line of 55% to 60% accuracy for at least a 1 hour move. When you're incorporating news into the equation, then I believe the win rate is incredible, is much higher. But look, this all depends. We could trade the exact same setup. You or I, we could trade the exact same setup, but we could still have different results because we're both unique. We both have different risk appetites. We both would likely prefer different stop loss placements and things like that. And I will get onto that shortly. How I trade, how I enter these markets, based on these patterns and things like that. But yeah, just bear that in mind. So let me remove this and remove this. And then we'll look at the charts. So here is a Quasimodo, an IQM. So I'll call them IQM. So it's an ignored Quasimodo resistance. So we have the low here. We have another low there. So we have a low, high, lower low, higher high, and then a move to the downside. And we have a relatively clean break, especially of this level here. I mean, look at this level here. Let's stick to the clean ones. Let's move this out of the way. Just going to show you another example. But we had a low here. Let's zoom in. We had a low at this point here, a high at this point here, a low, and a continuation to the upside. Now, what was really attractive about this setup was a clean break. This is on the monthly time frame, guys. So we had a clean break to the downside here, and then a retest of that level as resistance, and it's held again. Look at that. It's amazing how accurate these are. Now, the reason I added this one here was because you could also try to build yourself a resistance area out of these IQMs. So I took the low just above this low because it's quite a small one. And this is where your experience will start to kick in. So you can have this low here, this high, this swing low, and these highs coming up to this point here. The only issue here was this was not a very clean break. As you can see, we touched the level. We did see a minor reaction to the upside, and this could even be considered a retest. So I wasn't very keen on this level, hence why I was very happy to see this break at this point here. So I was confident that we could form a resistance area between here. So you could, based on that, you could have entered short at this point here and had your stop above there, above the high of the upper boundary of that pattern. You can also drill down to the lower time frames. I will try and talk about that a little bit uh, later on as well. We have another IQM here, but this is a bearish one. So this was a bullish one. Remember, low, high, lower, low, high, and then a break to the downside. Bullish Quasimodo support. Just to confirm, guys, these are I don't consider these conventional support and resistance levels. I consider these unconventional. So remember in the agenda, there was learn to distinguish between conventional and unconventional levels. Conventional is those textbook patterns I showed you on this chart here. These are unconventional, in my opinion. These are, although they are in some textbooks, they're not as widely recognized, I guess you could say, by technicians. But I found that the ones that are widely recognized by technicians don't tend to hold up as well as those that are unconventional and the ones that I ultimately feel comfortable trading with. So yes, this is the IQM. This is the bullish IQM break to the downside, and then we have a bearish IQM. So we have that high, low, sorry, higher high there, and then that low to this point here, and then we have that clean break. Remember, guys, that clean break. But look at this. We have that high at this point here in the month of April, this month, and then we look at that retest. It's just picture perfect retest. And then a strong move to the upside. So we have that's your left shoulder, low, high, low, lower low, and then a break to the upside, which clears that left shoulder and clears that high. Remember that. And then we see that retest of that level as support. Again, I have cherry picked these. So do your own due diligence regarding these levels, and I think you'll be pleasantly surprised if you do follow those very simple rules that I have outlined. at this point here. I'm also seeing one here. So we have a low here, we have a high there, low, strong move to the upside. But look, if I just ping that line across from this low here, it wasn't a clean break, right? We did get that reaction at this point here, and then we got a clean break to the downside. But look, we still see a nice reaction at this point here. Monthly time frame, guys. So you can really drill down to the lower time frames and start looking for those bearish entries. I say unconventional. The other unconventional support and resistance levels may appeal to more newer traders as they tend to be less objective. So we post a from one of our team. We post a daily publication called Levels of the Day, and what our analyst does is he looks at 1 year opening levels. He looks at 6 month opening levels. He also looks at monthly opening levels and 3 month opening levels. So 3 month quarterly opening, half year opening levels, and year end opening levels. So how do we go about looking at those? Now, this really opened my eyes when I was shown this to a different way of trading, a more objective way of trading. Now, I will just say it, just to be clear here, I think that these levels are so well respected. As the end of the months or the end of the quarter or end of the year tend to attract a lot of movement, so portfolio rebalancing and things like that. And there's possibly a lot of unfilled orders left around these levels to help price rebound. So let me just show you how these work. The best way I've been shown how to look for these levels is to simply use TradingView, go to your 12-month chart at this point here, and then we look for those yearly, because these are 12-month candles, guys. So then you look for the key opening level. So we have an opening level here. So we pinged that level across there. So as you can see, we've pinged that level across that at that point here. We have another one here. That's an opening level. We can then ping that across. That's another potential support. And that's probably, oh, we have another one over here as well. So back in 1987, guys. And these levels are still holding. It's just insane. So yearly opening levels. So just simply go to the 12-month time frame on the FP Markets trading view, and then extend those levels across. And you'll be surprised at the reactions they really do attract. So then we go down to the 6-month time frame. And we look for those 6-month candles. So at this point here, we could have pinged another level across there from that open at this point. Let me just remove the, there we go. So you could have used that opening level, pinged that across this one here, which is the yearly opening level. We have one at this point here we could ping across. So it's only closed candles, guys. So it could only be the 6 months that have passed. We can't use ones that are active. So we can't use this open here. So we have one there, we have one here, which is also the yearly opening level, and we also have one there. If I just ping that across now, no, I won't do that now because I'm not confused, but I think you get the drift. So you're looking for 6-month opening levels. We also have one at this point here, which is also a yearly open. These are yearly opening levels, guys, because they're so far back. Then we move down to the 3-month time frame. We then look for those 3-month opening levels. So one here, one there, and one up here. One there, and you extend those across. Then go down to your monthly time frame, and then you look for those monthly open. So we've got a monthly opening here. We have a monthly opening there. We have one here. Now the idea is then scroll down to the daily time frame. And then you look for those. So it's best to label these. So I was shown it was best to label these as such, and I found that they're really effective. So we have a 1 year support at this point here. Look how long price has held above this 1 year support of 146.58. This is on the dollar yen daily time frame here. 1 year support. Let me just check how far this was taken back from. Let's just go back to the 12-month time frame. So currently price is bouncing from this level here, and that was back in 1990. Extended across. Whoops, sorry. That was extended across from 1990. You just wouldn't be, it's just insane how well they hold. I mean, look, reaction, pretty poor reaction here. Pip perfect reaction there. Another reaction, a breakout to the upside, reaction, 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 reaction there. They really do hold price very, very well. And as you can see here, we've been holding above this level since about the beginning of August. I mean, look at that. This was withstood a number of downside attempts here. Then we have so the idea here is to look for those areas of confluence. Now, this is a bit more advanced, but this is where you get a collection of different technical tools converging at a price area. But with this technique, you can actually look for where those yearly opening levels, those 6-month opening levels, and the 3-month opening levels all converge. So we have a combination of a 1-month resistance at 150.68 and a 3-month resistance at 149.90. I mean, look at the reaction to that. This was at the NFP, the previous NFP on the 1st of August. Look at the reaction to the upper edge of that support. It's just mind-boggling how well these areas react. So again, this is what we call unconventional support and resistance levels, but this is something I was shown by one of our analysts, and it really blew my mind how obvious yet not very well not something that's shown a lot that I've seen. There's no textbooks that I've seen that talk about this. If there are any, do let me know because I'd be interested to read more. But what I've been shown and the accuracy that he's had with these levels, and yeah, it really is mind-boggling how well they they do react to price. So as you can see, we now we do have a 3-month support down here. We have a 1-year support. I mean, this 1-year support, let's see, 140.81. Let's see how far that was extended back. 140.80. I think it's this one actually, guys. 140.81. Yep, that was January 2024. So last year's opening level. But look, if we go to say the daily time frame again, that 1-year support all the way back from the beginning of 2024 here. So we took this level. Look at that reaction. Boom, rebound to the upside. Boom, rebound to the upside. Just off a 1-year support. There's nothing else there really. There's nothing else there. Not that I can see anything technically obvious at that point, other than this this swing low here. If I was not incorporating those yearly opening levels, I would never really look at that, to be honest. Or I might even trade the breakout to the downside, but that would have been considered a bear trap after the fact, of course. But yeah, this is something that really opened, as I said, really opened my eyes to a different way of trading. So we have conventional. These are the typical 2 tests, and there we have a support resistance level. The only one that I do look at are these pip perfect levels, and they are proving quite rare in today's markets. The other one I look at very, very closely are the IQMs, so the Quasimodo resistance levels and Quasimodo support levels that are breached and retested. And the other one I use, and this is it, I like to keep things simple. So I use the IQMs and I use the yearly opening levels as a yearly, quarterly, and half-year opening levels and monthly opening levels to find an edge in the markets in terms of support and resistance. So in terms of practical application and techniques, which was one of the bullet points on our agenda. So I really do like the simplicity. As I said, I really like the simplicity of the break and retest plays. This is essentially it. So we have a resistance here, we have a break to the upside, and we have a support retest at this point here. And then we have a rebound to the upside. Very simple. The thing that I've found in all the years that I've been doing this is that traders tend to want more confirmation. They want to have more validation to put their money at risk. But really, the more you add, I've found the best techniques are usually the most simple, is what I'm trying to say. You can add all the indicators you want. You can add the RSI, you can add the stochastics, you can add moving averages, you can add this, you can add that. But really, I've found the key to my analysis is looking at these IQMs, looking at these monthly and these opening levels here, and combining that with a macro backdrop. How do you enter and how do you place your protective stops? I do want to say that this will, of course, be very different to, I've said this already, but how you place your stop may differ from how I place my stop. How you enter, again, may differ. It's personal preference, and this is what makes trading so great because it's so flexible. So let's use there was a good example here, which is why I had the arrow. Let's remove this red line here. So this is the monthly time frame, that IQM setup. So that bearish IQM. So high, low, higher, high, low, and a break to the upside. And what I've found with these levels, if you're completely trading from a technical perspective, is to simply look for these. Look for these long-term breaks to the upside. So you have a candle close to the upside. So once that candle's closed to the upside, you then drill down to the lower time frames. What lower time frame? What do these work best on? You need to test this. I really can't answer that question. If I had a pound for every time someone asked me what's the best time frame to trade, I'd be rich. I would never need to, I'd never need to work. I've been asked that many times, and that really, truthfully, if anyone says the best time frame to trade this on or that on, I, I don't fully agree with that because I think it all depends on how you trade and there's so many factors to consider. Your risk appetite. Do you like to be at the screen for hours at a time, or do you prefer to look at the daily time frames once a day because you work full time? There's so many things to take into account. Anyway, so we have a break to the upside. This is one way of trading these from a technical perspective. So we have a break to the upside on the monthly time frame. Let's say we drill down to, I think it was the 4 hour time frame I found. These were just look at this. I mean, it's a picture perfect setup. Break to the upside, a clean break to the upside on the H4 time frame as well. Clean break, no retest. And then what happens on that test there? Beautiful, absolutely beautiful. Let's have a look on the daily time frame for that level there. Yeah, so we another clean break. So a clean break on the daily time frame there. And a nice retest of that level as support. Just beautiful. And you can how you enter. So for me personally, I don't look for any additional confirmation techniques at these IQMs because I think they're very, very high probability as they are. Some people look for the approach. I, I tell a lie, but here, I remember this setup. I do remember this setup actually. Um, let me just, I do take to account other variables, but I believe these are levels that are high probability in and of itself. But given my experience, I can normally spot something that is also playing out. So here we have a head and shoulders, right? We have the head, the left shoulder, the head, and we have a complex right shoulder here. We have the neckline at this point here. We have a break to the downside. I think this lined up really nicely. I think it was very close to the pattern's profit objective. So that's another reason you might see profit taking around this area. And I knew that we may overstep that mark. We also have an AB equal, I think it was an AB equals CD. There we go. An AB equals CD 100% projection ratio at this point here as well. There was a number, so many things complementing this area that it was very hard to ignore. Now, a more conservative way of entering, and I do this on occasion, especially if I see a strong move into the area like this. This was a strong move. So I would be looking at this resistance, this supply, excuse me, at this point here. I would be looking for this area to be broken before. So I would enter long, and then the next question is, once you've entered long, you've placed your stop below the next area of support. That's something you'll have to find for yourself because you could even use just below this area here, which probably would have had you stopped out. Um, or you could take it to the next swing low at this point here. That's totally up to you, but that would be a little bit too big for me. Anyway, so we've entered long, we placed our stop somewhere down here. Then we look to manage our trade. This is where the emotions can really play havoc with you, because a lot of traders will be 1R in favor, so they have double their so if they've risked 100, they've made 100 at this point here. What do you normally do? You normally take a little bit off the trade and then you move your risk to break even. So you've taken, say, half at this point here, then you've been taken out only to see this happen here. So what I've found with my experience is it's generally best to wait. It's generally best to wait and see what price action tells you to do. So we know we have a supply at this point here. You could wait for price to react. You could wait for price to react. If you see something solid like this supply here, wait for price to react. Wait for price to do its thing. Wait for price to hit this area, come back, test. And if you see buyers starting to come in at this point here, then take an entry and then place your stop below this low here. And then once price breaks above this supply, you can then look to reduce your risk to break even as you have some protection. You have now a supply area that's reacted, broken to the upside, been retested as support, and now we have protection. So you let price action tell you when to move your stop to break even. So at this point, we have price rallying. How do you then follow price action? You can then simply follow the swing highs, and lows, follow this, and you'll have probably been taken out. If you'd have followed it to the T, you'd have probably been taken out around this point here. So you'd have entered down at this point and taken out up here. Whereas if you'd have entered long here, took off 50% of your position and being taken out at break even here. It's all about patience, and it's all about understanding and letting price action decide what the best course of action is. And I think that really all comes down to your psychology. And I've done a number of presentations on psychology regarding trading mindset and things like that. And it's so very important. So analysis is one thing. You then have your psychology, then you have your risk management. This is why I believe so many traders tend to struggle with trading, because there's so many elements to consider and they don't consider it. They just want to analyze charts. And I understand. It's how I was when I first began. I just wanted to learn. I thought I'll find the best support and resistance. I'll find this. I'll find the best indicator, and everything else will fall into place. It's not the case. You need to be well versed with not only market analysis, you also need to be well versed with your risk management. You need to know, you need to trust your process. You need to test your process. Test it. Go into it as an experiment. So you have to find these setups that are proving to be have an edge on demo before you go into live. Go into a live trading environment with the statistics to give you the confidence to keep trading. Because once you're trading live, if you get a loss, two loss, which you will get, a third consecutive loss. I know a number of traders, they were awesome traders, but they just couldn't hack losing that amount over three consecutive trades. So you really need to have the statistics to back it up. So if in demo, you've lost three consecutive times in a row, and you see that in your live trading, you won't fret so much in when money's on the line. So there are a number of ways to go about this, but yeah, that's really all I have to show. So what I consider unconventional approaches are the IQMs or the QMs reversed, and those yearly opening levels. Guys, they really are something. Do look into them. If you need, are there any questions, guys, while I'm switching back to the other slide? Bear with me. All right, so that's really it from my side. As I've said, I've shown two unconventional ways of trading. I've shown what I consider to be conventional support and resistance. And as I said, I do trade one of those ways, but I do prefer the IQMs and those yearly opening levels, yearly, monthly, quarterly, and half yearly opening levels. I do hope this presentation has shed some light on a different way of approaching, a different way of navigating market structure using different support and resistance. We hope to be doing many more webinars like this in the future. So please do send through your ideas and for future topics. We greatly appreciate that because we want to present what clients want to learn about. If there are any questions, please feel free to send your questions to marketanalyst@fpmarkets.com. Also send your feedback and comments. That's greatly appreciated, where you can get hold of the research team there. Once again, thank you very much for joining us and have a great day. Thank you.